So the Australian investor is really not well served in a lot of ways, by which I mean if you look at the tax office data, it's official data from 2013. It's a couple of years out of date right now, but the numbers really haven't changed all that much. There was 500, there's now 600 billion in self-directed, self-managed super in this country. 150 billion of that is in cash, $150 billion in Aussie equities, $2 billion only is in offshore equities. There's $150 billion out of $500 billion in Aussie equities and $2 only in offshore equities. That means self-managed superannuants in this country are dramatically underinvested in the companies that are essentially remaking the business landscape in the 21st century. I mean, you know, you can get access, well, it's possible, you can't get access to the Ubers, so to speak, and the Airbnbs right now because they're private. But a self-managed super investor can certainly get access to Apple and Google and Tencent and Baidu and Alibaba, and those things are not happening in the Australian market. That's part of the reason that we exist, to provide that linkage. It would be crazy, because Australia is so underrepresented in disruptive models, in the new way that business is being done. The Australian investor, therefore, is underrepresented with respect to those companies, and that is a very, very dangerous position. We did some work that basically looked at the top 100 companies on the Forbes list between 1995 and 2014. 44 of them had dropped out. And there is MIT, Massachusetts Institute of Technology Research, that basically says at this rate, 27% of the companies in the top 100 will have disappeared by 2027. So that's 1 in 4, and that's in the US market. It would only be worse in the Aussie market, as it were, because we don't have the benefit of some of those big disruptors that are really remaking the whole shape of business. The reason that you need to have some level of divestment is because if you think about your big expenditures on an annual basis, you buy your car from offshore, you buy your holidays from offshore, you buy all your white goods and furnishings from offshore. There's a lot of things that people buy from offshore. If you are just in the Australian dollar, as it were, if you're only in Australian dollar assets, then you don't have a natural hedge for the things that are going up in value because the Aussie dollar is falling. So if you suddenly were paying, you know, X dollars for your car, you're paying X plus 30% for it because the Aussie dollar has, you know, gone down by that much. If you had assets in the same currency, some of that increase would be, you wouldn't have to pay as a result of the fact because you'd made a currency gain. I mean, it's that simple. You should look to match your spending with where your assets are domiciled, so that you don't have a mismatch in terms of your spending and your income.